In a world of constant change and innovation, trust is key, knowledge is power, and the inside track is everything. Ladies and gentlemen, please welcome Bruce Whitfield.
Hello, everybody. Welcome to Inside Track. And welcome, please, if you would, Nick Stephenson. Nick is the head of Mezzanine Finance at First National Bank.
Hi, morning, Bruce. Yes, well, mezzanine finance is really that gap between equity and senior debt. So if I were to run through an example, say you acquire an asset for 100 million rand, the bank gives you senior debt for 70 million, it means you need to put in 30 million rands worth of equity. Maybe you don't have 30 million rand available in cash resource, or maybe some of your money is offshore. What we can then do from FNB mezzanine finance is we can finance a portion of that equity and match you on a one-to-one basis. So as a buyer, you put in 50 million rand equity, I'll come in with 15 million rand mezzanine finance, and then you get your 70 million rand senior debt finance from FNB.
This is obviously, it's an instrument which is aimed at commercial property developments. And this comes with a whole bunch of T's and C's, as so much in banking does come.
Absolutely.
So typically I want to fund, we don't need shopping centres, maybe a residential development. How would I use mezzanine finance in funding a residential development, for example?
We largely actually focus more, not in the residential space, but actually more in the commercial space. So yeah, so we would look at more your logistics warehouse where you've got a third-party tenant as investor in that, or in fact the retail centre as you mentioned. We would also look at, well, in the past we would have looked at offices a little bit more closely, but there's a bit of an area under distress at the moment. So really those are the assets that we would look at. So yeah.
I was wondering just how many days a week you're playing golf at the moment, because I can't imagine that there's too much demand for retail right now, for new retail, and certainly office developments, as you say, are under pressure. Yeah. There is a lot of opportunity in logistics. Let's focus on logistics. Yeah. I want to get a piece of land. I want to put up a big warehouse with great access to highways, with great ins and outs. How would I go about it?
Yeah, well, first of all, you'd be phoning our senior debt consultant at Commercial Property Finance. Then you have a long discussion with them to see, well, how much would you actually lend me? So there'll be we'll look at the lease that's going to be in the background for that development. You know, who is that lease with? And then they will come up with, my colleagues will come up with, say, and let's talk about the 70% again. They'll come up and say, look, it's 100 million rand development cost. We can finance you for 70 million. And then my colleagues will then call me and say, look, Nick, I think they're a little bit shy on their equity because they've got money offshore, or the cash is tied up in the other commercial property portfolio. I think there's actually a gap here where you can assist and actually provide some finance, or between 10 and say 15 million of that development cost. So and that's where we would come in, Bruce.
The mezzanine finance is that lovely little layer in between the equity and the shortfall in equity. Yeah. And you then obviously need to have that underwritten by some other assets, because this is in the same way as you might go to the bank and get a bond. They want to have an idea that you'll be able to repay it eventually.
Yeah, well, so we end up going in partnership with the Commercial Property Finance senior debt. So we'll actually have the security be under the same bond, so the same first bond. So that's where our security actually sits. What does happen though is we rank second, the Mezz Finance ranks second to the senior debt. So if the asset were to default for any unfortunate circumstance, then the senior debt would have first dibs on that bond, and then we would rank second behind them, and then we would take, and then the equity providers, they would be third.
What are the benefits then of mezzanine finance? If you are an investor, why would you go the route of mezzanine finance and not seek out alternative sources, or use your own capital in the case of a development like this?
Yeah, I think firstly, if you do have capital and you have spare capital or surplus capital that's lying, and there's no opportunity cost to doing some other investment, then certainly use your own cash. I mean, that would be that would be my advice that I would pass on. If that money is tied up in generally what happens in the commercial space and commercial investor space, the investors are generally quite asset rich and cash poor. So, this is a good way, rather than diluting one of your assets or selling off one of your assets, you can actually use our financing, the Mezz financing. And yeah, so those are the main reasons. And then another reason is you could always, of course, get another equity partner with you, but that means you're now diluting your interest in that asset. So here, what we can do in the way that we structure the deal is in 3 years' time, so we can amortize, the loan will come off, will amortize, and then that will create some surplus cash through the amortization of that loan to actually take out the mezzanine finance in 3 to 5 years' time, and you remain 100% owner of the asset and you haven't diluted in any way.
So typically then, I mean, you aim for a 3 to 5 year exit. Is that normal? Can it be extended? Can it be shortened?
Yeah, I mean, that's the broad term. I mean, we could go a little bit lower. I don't think beyond 5 years. I don't think there'd be much appetite beyond that. Really, because you look at leases nowadays, all a bit shorter termed. Maybe in a logistics park, you will get a longer term lease, but most leases are around about 5 years. So we need to look at the exit quite closely for the mezz finance. And I think also at some point...
How do you price mezzanine finance? How do you price mezzanine finance in an environment like South Africa, which has got economic growth issues, it has got revolution issues? We saw, of course, the riots of July, and those were deeply uncomfortable, and we saw a huge amount of physical real estate destroyed during that time, and I'm sure plenty of warehouses and logistics centers as well. How do you begin to price for the risk of lending money over 3 to 5 years? Yeah,
so I mean, interesting question. So I think what we need to remember is that we are actually in the equity space. So the senior debt, so the normal debt financing only gets you to 70%. So if you were a typical investor in that asset, you'd probably be looking at what we call an internal rate of return of 20%. An internal rate of return being your discounted cash flows through a period. Because the mezz finance comes in under the bond, albeit ranking second to the senior debt, we actually be able to get to an internal rate of return of 15%. So that's how our pricing is. This is where people normally fall off their chairs. That's prime plus 8%. So it's a high rate, but your equity investor, if you're to think of it from an equity investment perspective, if you're looking at a 20% IRR, that's prime plus 13%. So there is a benefit there. So again, I'll go back to my original statement or comment, which is if you've got cash that's sitting around, use your own cash rather.
No, absolutely. But prime plus 8 is a chunk of cash. It really is. Yeah. But I think it reflects then the relative risk within these investments. And that is, I suppose, where you've got to make some money. Everyone wants to make money out of the deal, and there is a high level of risk associated then with mezzanine finance.
Absolutely. The way that we model, and not to get too technical, so if you have a debt service cover ratio of, say, 1.2, which is a debt service cover ratio is what your net income is divided by what your interest and capital repayment is on a per annual basis, that's your debt service cover ratio. And normally, the senior debt, they all lend at a 1.2 debt service cover ratio. What we do in the mezz finance is we actually sweep that cash, that 1.2 to the 1. So unfortunately, as an investor, you won't see much cash over the term of that mezz loan because we're actually paying for interest. The upside is of that, though, in 3 years' time, when we exit, there's a strong chance that the senior debt will be able to refinance, get the level up again, the senior debt, because they've gone down to a loan to value of, say, 50%, revalue that, and take me out from a mezzanine finance perspective. And the upside is you're 100% owner of the asset that you've acquired.
Now, and that is the great advantage, of course. I mean, are the rates considerably higher in South Africa because of domestic risks as opposed to more placid places, perhaps?
No, not necessarily. I think if you look at IRRs across the world, any private equity fund, IRRs are high. They are in the sort of 20% range, and that's what investors seek. I think generally in the property space, it is a little bit lower because there's an asset that underpins the investment, but equity investors, private equity firms ask for a high return.
And then talk to me about the risks then of mezzanine finance. You've touched on a few of the risks, but just summarize the sort of risk spectrum, if you like.
Yeah, so I mean, the main one is at the exit, or if there's a default event. I mean, say you lose a key tenant in your asset, how are you going to now pay for the equity finance? And in fact, how are you going to pay for the senior debt finance? So losing a tenant, that could be a big issue. So maybe you do have to put your hand into your pocket as an investor and actually pay out the mezz finance, expensive finance. So that is a risk. And if the asset goes into full default, there could be a cession of shares as security, meaning that you could lose the asset if in case it does default and you can't settle the obligations to the bank.
And I mean, again, you go in with your eyes wide open, and more often than not, I mean, I'm sure that mezzanine finance is a recurring occurrence, and the vast majority of people who have taken out one loan understand the inner machinations. But you will have first-time clients. You will have people coming to you and saying, "I've heard about this thing called mezzanine finance," and I'm sure there's a lot more hand-holding in the beginning of a relationship like that than somebody who's done this 10, 15, 20 times.
Yeah, absolutely. I mean, we are partners at the end of the day because we are basically both equity partners. The only difference is from a mezz finance, we're out in 3 to 5 years time. So yeah, a lot of hand holding and explaining how this works. And we also most of the investors that we're with, they're largely astute investors. They understand it. They understand the value of money. But yeah, definitely a hand-holding process. Eyes wide open on this one.
What do you consider? What do you look for before when somebody comes to you and says, "Here is the piece of land. Here is the potential tenant. This is the plan for the next 5 years." What do you look for when I bring a proposal to you?
The first major item is actually the person or the sponsor, or what you refer to as the jockey sometimes. We look really close. What is their history? What is their background? How have they behaved in the past? So it is really important that we partner with the right people. That's number one. That's the top of the list by a long way. And also in the case of default, is a history of that investor actually digging into their pockets and actually coming right. So that's number one. Then we start looking at the property. Fortunately, because we're coming in from FNB angle, this is FNB, we do the mezz finance, or I do the mezz finance. My partners at FNB Commercial Property Finance, they'll be doing the senior debt. So they'll be looking very closely at the property fundamentals, a lot closer. Well, I'll also look at them very closely, but a lot of that due diligence has already been done on the senior debt side. So definitely sponsor number one, and then property dynamics number two.
How do I come to you? What sort of track record do I need for my first stab at mezzanine finance? If I have no track record in borrowing large amounts of money and paying them back, how do I let you know that I'm a good risk?
That will be a little bit tricky on the first run deal. We like to go with experienced property players that know the way around the game. As you know, property may look quite simple, but it's not as simple as what many people believe it to be.
But is there not a big transformation agenda here as well, where you've got people who are coming into the property sector for the first time, looking for an opportunity? And I think of first-time black developers, for example, of properties. How would you evaluate their risk?
Yeah, I think at the end of the day, because there's such a large equity requirement from their side, I mean, even let's go back to the 100 million rand example again. 50 million rand is still a big check to write in anyone's world. So that money would have been made somehow, so there's a track record there somewhere which we can then sit down and run through. It may not have been with FNB, it may have been with another financial institution, but we'll look at that track record, and we'll, there's also, we'll balance it, then we'll also maybe put a bit more weight onto the property fundamentals to say, this is, from a mezzanine finance perspective, we're only in for 3 years term, and maybe there's a triple net lease for 10 years with a listed company. Then we're going back to say, well, it's highly unlikely that this asset is going to fall over anyway because there's a listed entity as a tenant for the next 10 years and we're out in 3. So there are many ways to look at this, Bruce.
Yeah, absolutely. And then I think that's important as well, even if the applicant doesn't have a track record in property development, perhaps. I'm just wondering just how finely you can slice this thing.
Yeah. No, you got to look at it all. It's all the ingredients to a cake. You got to look at all the aspects, yeah.
So when you're analyzing and you're looking then at, you look at a personal balance sheet, you look at a personal track record. If there's a company, you'll look at that corporate track record. The value of the tenant, I think, is the gold in this arrangement, because that is almost more important than any other aspect. Who is going to be in that property, for how long, and what is their sort of likely longevity?
Yeah, absolutely. And that goes back to the senior debt. They're going to do that analysis very deeply, as we will too. I think if you look at how that's changed in the South African landscape over the last sort of 3 or 4 years, if you look at a convenience retail center, it used to be one food anchor, then a lot of what we call mums and pops. I mean, you look at those convenience centers now, they're generally 2 big food retail anchors that are now sitting in that, and the mums and pops are now sort of pick and pay clothing that have come in for the clothing stores. So the quality of the leasing has actually improved quite dramatically in a lot of these assets. But yeah, fundamental, the lease, the paper in the background is very important.
I mean, once you give a kid a Coca-Cola at the age of 5, once they've tasted it and they've had the fizz and the sparkle and the sugar rush, they don't go back. And I wonder if mezzanine finance is a bit like that as well, where you have people who are willing to live in a highly geared world, growing asset values as they go along, whether or not this mezzanine finance concept is something that is part and parcel simply of building great pools of profitable property over time.
Yeah, I think the property game is a long-term game. So yeah, for 3 years you're not seeing much cash coming back off your investment, but after 3 years you now own your asset. And if you've got a 10-year or 15-year time horizon, you can build up a portfolio that way. And you can build it up largely because you haven't put all your equity into one asset. You've now been able to buy 2 assets. If you had 30 million rand to start off with, you can now buy two assets for 200 million rand, and FNB's Mez Finance has come in for 30 million of those 2 assets. So it's a good start in a highly leveraged space. Yeah.
How busy are you?
Yeah, there's reasonable deal flow. Yeah, we're going okay. It's a new business for FNB, so it's taking time to get the wheels to turn, but we're getting busier, absolutely.
And how interwoven then is the appetite for mezzanine finance with business confidence? I was looking at a Bureau of Economic Research graph the other day, and business confidence has been below 50 for probably 90% of the last 10 years, the last decade, and all of the stuff that we know about. And we came occasional little blips of positivity. It probably is a long-term game. Yeah. It requires surely a high level of confidence, not only in the present, but in the future. I wonder just how intertwined those are.
Yeah, very intertwined. What we're finding is when you talk to a client initially to when the deal is actually concluded, that length of time has grown dramatically. So deals aren't happening overnight. There's a long period. We saw clients in the Eastern Cape in September last year. I think we're going to pay away in about 2 weeks' time. So that's a year. All due diligence done, everything in place, but it takes a lot longer than what it possibly has in the past.
And also, inefficient local authorities must play a huge role in this too. And we've seen the destruction of so many municipalities over the years too, and the capability within those municipalities to do even just the basics effectively.
Yeah, it's probably a matter for the broader property sector that we've all got to be very highly considerate of, and also even transferring assets, to get race clearance certificates, deeds offices, opening, closing. It's just been a tricky period from that side. So yeah, and also the municipality from a service delivery under pressure. I mean, so we also look at it from maybe some of the Mez Finance actually goes to installing your solar. So you buy the asset for 95 and you spend 5 million on solar. You need to start making your assets more sustainable also. So we see that as a win-win situation really from that side.
Again, that's one interesting concept because the cost of projects then rises as a result of failure of service. And the more you can sort of insulate yourself from possible really big cost rises in the future or an incapacity to deliver in the future if you're on a municipal grid that's not been properly serviced, that's a crucial backstop.
Yeah, absolutely. But what we do find is the solar insulation is quite a big yield kicker, which what means is actually enhances your yield if you look at it over time, and possibly going to continually enhance your yield if the prices of electricity and power keep on the same trajectory.
Nick Stephenson, thank you very much. He is head of mezzanine finance at FNB Commercial. Fascinating insights as to how mezzanine finance works, who should use it and what it costs. But in a world of returns, if you're getting 20% returns, it then makes sense of the short term, of course, to take mezzanine finance. Thank you, Nick Stephenson, very much for joining us on this edition of Inside Track.
Thank you.